welcome to the show remotely today. I'm in Virginia, Jerry's up in Massachusetts, and we hope this works.
We hope it works. Yes, we do. IT is not my friend, as you all know by now. But man,
All right.
it is
What do you got for us
actually
this week?
some benefit. So some benefit is that we couldn't get this recorded on Friday, so I have the charts done through the week. So the charts this week actually go through the whole week. Um, so let's get on to it. TSP Weekly Podcast, 8 September 2024. So we'll talk about what happened this week. It was a holiday shortened trading week, but it's one of those weeks where, a month's worth of stuff happens in a week. Then we're going to take a look at a Facebook post. Got a lot of traction this week. It's kind of an interesting one. And again, back to seasonality because now, we are in the midst of the two worst trading months of the year. Bonus chart is the employment ratio, which is kind of interesting. We'll take a look at, and then the TSP fund charts. So what happened this week? We had Monday was off for Labor Day. Tuesday, ISM manufacturing PMI was up a little bit to 47.2 from 46.8 in August, but new orders and the pieces within the PMI index were declining. So like construction spending fell 0.3. A reading below 50. So right now we're at 47.2. A reading below 50 means the economy is in contraction. And it's been below 50 since October of 2022. And then, on Tuesday, the S&P was down 2.12%. Wednesday, we got 30-year mortgage rates only falling, 1/100th, barely moved, which is kind of surprising because rates did come down, which is why the F fund went up. But 30-year mortgage rates didn't fall much. You got the JOLTS, the job opening and labor survey, falls to 7.67 versus 8.1 million, which was forecast, which is not good. It means the job openings that are available for people to take are decreasing. So on top of unemployment, the available jobs are also decreasing. So S&P falls pretty much flat, but falls 0.16% on Wednesday. Thursday, we get initial jobless claims that were in line with forecasts at 227,000. Previous number was 232,000. Maybe the layoffs, are beginning to stabilize possibly. S&P is down 0.3 on Thursday, and then Friday was a big down day. Payroll and unemployment data came out. New payrolls came in less than expected, 142,000 versus 161,000 expected. But even though new payrolls came down, unemployment also ticked down to 4.2 from 4.3. But the market did not like that. S&P was down 1.73% on Friday. All right, so this recent Facebook post. So, hey guys, this might sound obvious, but with high cap stocks like the S&P 500 reaching new levels of stock price, wouldn't it make sense to also invest in small and mid caps, the S fund in this case, to mitigate the lower or negative returns that follow afterwards? I'm not sure what exactly that means, but I asked this since the S&P, the C fund, makes up 85% of the total stock market, and the S fund makes up the other 15%. So I thought it would make sense to diversify since they don't usually fluctuate in the same manner. So the last kind of sentence there, I'm not exactly sure if he got it backwards or if he was looking at it from a cap weighted basis. So the S&P 500, there's roughly 5,000 publicly traded stocks in the US. The largest by market cap are the S&P 500, right? The top 500 companies. The other 4,500 companies make up the S fund. So it's really more like 85% S fund, 15% C fund in terms of the number of companies, but not in terms of the cap weight. So I'm not exactly sure what he meant by that. But the crux of it is, does it make sense to use the S fund to diversify the C fund? And so we got some pretty interesting comments on there. So this person says, I used to do 50C, 50S, learned some things from Buffett and some other guys, and he ends up going to 100% C fund. I'm glad I did because I'm up 19% year to date. Okay, so in this answer, he's only talking about the C fund year to date. But it's not all sunshine and rainbows. If it crashes hard, I might wish I was 50C, 50S. The S&P has been outperforming, but remember a month or two ago, it started to crash and small caps were going up. If you watch CNBC and any of those guys, they're saying small caps is the way to go. But now the large cap is doing well again. So everyone totally forgot about small caps. How quickly we forget. That was a month or two ago. The S fund broke out of that triangle consolidation, and it was outperforming the C fund for a minute, but then it rolled over. But that was this idea that the underlying market was broadening out. So yeah, CNBC was very excited about that, and then it reversed. So a mix of C and S could be smarter move to diversify, or maybe if you're like me, you think the S&P 500 is already diverse enough and willing to take the risk for gains. I think it's really a personal choice. It certainly is a personal choice, but we're going to get to a chart of the CNS fund and see how we actually can answer the question. So the last one, I think it's the last one. My big problem with the rationale is this. Both the C fund and S fund typically move in the same direction. Generally, that's true. So you're not mitigating any risk by adding S fund to your portfolio. If C is dropping, S is probably dropping too, and the inverse is true. That's true. But if you looked at something like 2022, the S fund was down 40% and the C fund was down 25%. So while they go in the same direction, one can go much higher than the other while they're both moving up, and one can go much lower than the other while they're both moving down. C fund outperforms the S fund. So while logically it seems to make sense, what you're saying, it's hard to get around the fact that no matter what percentage of S you add to your investment strategy, you are adding a lower performing fund at the cost of having to take investment dollars away from the higher performing fund. There are definitely times when the S fund outperforms the C fund. It's not a fact that the C fund outperforms the S fund all the time. So a lot of people do some mix of C and S. They seem perfectly happy with their decisions. I've never been able to convince myself that C and S together is even as good as C alone, let alone better. I think a lot of people would disagree with that because there are a lot of people out there that look at the S and think it's a much better long-term proposition than the C. But again, it's personal choice. And then this is the last one, and this is kind of the one that I sort of agree with the most. Every dog has its day, right? All these funds have their time to shine for sure. So it just depends on the market cycle. So far, the C fund is a clear winner over long periods of time. We'll see about that. Now throw in some active management, and it all depends on when each fund shines. For example, the S fund might do better once the Fed lowers rates. Yes, if we get a soft landing, the S fund should do better when the Fed starts cutting rates because lower rates are more stimulative to small companies than they are to big companies that really aren't taking on any debt anyway. Okay, the C and the S fund. So how do you answer the question? Is it better to be in the C or better to be in the S? The way you answer the question is to look at a ratio, right? So this is the ratio of the C fund in the numerator and the S fund in the denominator. So when the black line is going up, the C fund is outperforming the S fund. When the black line is going down, the S fund is outperforming the C fund. So this is a monthly chart going back to 1987. So if we look at it and you're trying to decide which of the two funds you want to be in or which one is outperforming the other, right? Clearly, say from 95 here, the C fund is outperforming the S fund as we get as we get into 1999. Okay. Then for the big blow off top into 2000, at the top of the tech boom, the S fund was killing the C fund. Okay. And then the C fund comes back, makes a comeback. But from 2002 or three in there, all the way to 2015, over that long period, the S fund outperformed the C fund. So it rather than having an opinion, it is really good to look at the actual data, and all it is a ratio, right? We all remember 20. Where are we? This right here was going into 2021 after COVID. So the thing that you kind of can't, the thing that this chart does not tell you is whether or not the funds are both going down, right? So if they're both going down, you don't want to be in either one of them. But the S fund hugely outperformed the C fund in that run up after COVID. That's what that line is. And then once we bottomed, the S fund bottomed in 2021, and the C fund for the past couple of years has been outperforming the S fund. But it is not very likely. It will eventually go the other way, and the S fund will start to outperform the C fund again. So it's a matter of looking at the ratio, and you can apply the same kind of technical analysis that we always do. We definitely had a rounded bottom here, right? We had this you could have drawn this long-term trend line, and once it started, you get a lower low, now you get a higher low, right? So it's turned. That's how you would do it. That's how you would figure it out, rather than having just kind of a standalone opinion. And I thought this chart was pretty interesting. So it's obviously the same chart, and the green rectangles are recessionary periods. So to the point of the last person's comment, does the S fund do well when the Fed lowers rates? The Fed lowers rates during recessionary periods. That's what it's doing. And so the S fund is outperforming, right, in all these times. Right. This was what I was talking about. We came out of COVID. This is the COVID recession, and the S fund was killing it. And you always see the C fund leading going into recessions. Right. You get the C fund leading all the way into all these recessions. So it's very possible that if we get into a recession sometime in 25, the line starts spiking down. So just have it on your radar.
Yeah, and just to point out, we have these ratio charts for all the TSP funds on our website. Now, I'm pretty sure it's for the members only, so you have to be logged in. We do have charts up there for the different funds, but the ratio charts, you have to be logged in. But they're very useful at any given time. As Jerry pointed out, you can see, is the I fund outperforming the S fund, or the S fund outperforming the C fund. Like, it's not just the C and S that this works with; it works with just about anything. And ratio charts are very handy, as Jerry pointed out. And the just to give my 2 cents about the Facebook post there. I mean, it's amazing to me still that so many people are so adamant about what they consider factual that doesn't necessarily make a lot of sense sometimes. And I'm trying to say that as delicately as possible, because I understand it. This is an education show. This is what we're trying to do. But I almost feel like they don't watch it. If you're making comments like that, like, just watch a couple of these shows and you'll see how these work. I mean, right now, the F fund is killing it, and nobody would believe that a month ago. I mean, we would. We've been waiting for this, right? We've been talking about it for months, that the F fund might have its day, and here we are. The CNS fund are collapsing, and we're going to see this in the charts in a minute when Jerry goes over them.
Yeah. I mean, on a day-to-day basis, it's kind of hard to track the market and all that. But over time, I mean, a chart like this is really good. It tells you a lot about what happens over time and what happens going into recessions and coming out of recessions. And it always happens that way. I mean, the odds of us not having a recession in 2025 are slim to none. there was 1995 was that one period that the Fed was able to engineer a soft landing. But that was, right as the tech bubble was just about to take off. So can AI generate something similar to the tech bubble in 95? It's possible. We'll have to see that, you can't rule out the possibility, but the odds of us being in a recession by next year way outweigh the possibility that we won't. All right. And so seasonality. So this is really the next couple of months. This is a chart from JC Peretz at All Star Charts. And it's pretty current. It's only a few days old. So we didn't get the move down on the chart. We had a pretty big move down this week. But this is the window that we're in. And the blue line is the average election cycle. The black line is the last 10 years. The gray line is the last 5 years, right? The last 5 cycles. So the last 5 cycles, huge moves down on a percentage basis, right? This is a percent. So you're down here. The average of the last 5 cycles, you're down here 5%. It's just, there's no guarantees that the market can't keep going higher through September, October, and keep on going higher. But it's just historically, it's not usually what happens. So if you want to risk, you're kind of rolling the dice, and the odds are against you. Doesn't mean, like JC's not saying to sell everything and go to cash. Actually, I'm going to get to what he does say on the next slide. But for us, all we can do, because you're already in the market. So the best you can do when it starts to roll over is avoid this, right? We're trying to avoid these big drawdowns. That's the whole point of this. If you're a trader like JC, right? So he says the big question is, what do we do about it, right? He's putting this out to his people that, hey, we're going into the two most difficult trading months of the year. So what do we do about it? Do we sell everything because stocks tend to have a hard time, or do we buy everything and pretend these cycles don't exist? Or do we pick our spots, finding good opportunities when they come, regardless of what the seasonal studies tell us? For me, it's the latter, right? In my experience, we want to evaluate the seasonal trends for the market after the fact. So this is pretty interesting. In other words, we want to pay closer attention when markets ignore the seasonal trends. So if stocks do well, for example, during what is historically a weak period over the next 6 weeks or so, that would be evidence of overwhelming strength in the market, right? If seasonality says that the market should be rolling over and it doesn't, it keeps moving higher, then the uptrend is very, very strong. He doesn't say in here that he expects that to happen. He's saying he's watching for it. And we have this article from Bloomberg. It's a few days old, but I got it off of Yahoo Finance. Treacherous September is leaving traders everywhere on edge. September has traditionally been a terrible month for traders, and risks being even harder to navigate in 24, given lingering questions about the Fed's anticipated interest rate cut. Bond stocks and gold have typically suffered losses in the month as traders reassess their portfolios after the summer break. S&P and Dow Jones have had their biggest percentage losses since 1950 in the month of September. Bonds have slid in 8 of the last 10 Septembers. So that would be the F fund for us, has gone down in 8 of the last 10 Septembers. And gold has dropped every year since 2017. Investors may need to prepare for stormier weather this time, facing uncertainties, including a crucial U.S. jobs report, which we got this week. The market didn't like it. Seeing key to the magnitude and frequency of the Fed's future interest rate cuts. Right now, I think it's evenly split whether the odds of a 25 basis point cut or a 50 basis point cut later in September. Stocks trading near records and treasuries enjoying their longest winning monthly streak in 3 years look vulnerable to data shocks or surprises from a tight U.S. presidential race. Fall comes with falls, especially with market market's pricing in so much for Fed cuts and people chasing the Goldilocks scenario out there. Markets would be more edgy than normal. So, I mean, it's just an example. Everybody is worried about September, and they should be, because this is the global stocks. Okay, it's not just the S&P 500. It's MSCI World's monthly average. So around the world, September is by far and away the worst month of the year. So again, this is just it's knowing what historically happens and deciding, making a conscious decision whether you want your retirement account at risk during what is always the riskiest month of the year. That's all we're saying. Okay. Employment ratio is pretty good. Not a great timing tool, but it's a really good chart to take a look at. So the employment ratio is the number of people that are employed divided by the number of people that are able to be employed. So it's an age-based number. So when the employment ratio is going up, the market's doing well, right? Ratio goes up, market goes up. When the ratio goes down, it's just another way of looking at unemployment. But when the ratio goes down, except for 95 here, right? This was the breakout in 95 that we avoided. But these are the recessionary periods. Okay, these are the recessions. No, let me take that back. Those are not the recessions. I did this chart a couple days ago, and I'm trying to remember what I did. When the employment ratio rolls over, the market it's a tough environment for the market. Okay, so this one back here in 1990 wasn't that bad. When the employment ratio rolled over at the top in 2000, the market rolls over. Same thing in 2007, market rolls over. Obviously, COVID, right? This was the market came down. The employment ratio came way down because everybody got unemployed immediately almost. But where we are right now, it is pretty clearly rolling over, right? I don't think anybody would disagree that that's rolling over. Is it possible that it continues sideways and turns back up? It's possible. There's just no historical precedent for it. So it's we get down here and we take out that trend line. The market's going to be in trouble. So all these things are just to show, like, now is not the time to bury your head in the sand and think that you're going to get returns from the TSP like from 2009 to 2022, because it's not going to happen. Okay, TSP fund charts. So this was the C fund we put up last week. Each tick is 1 week of price action. The blue line is the 20-week moving average line. This is the relative strength indicator down here. And we did this Fibonacci projection. So we took from the top in 2022 to the bottom in October 22, and we projected to see how high price is likely to go. The most common projection point is 1.618. Okay, so this length from the 0 line to the 1 line, right? If you multiply that by 1.618, this is where you get. We came up and hit it, got rejected from it that week, had that pullback that we had earlier in the year, did a really good V bottom, came back up, hit it again, got rejected at it. That was last week. Okay, this week, that's how it ended up, right? And this is the weekly close. So if you're following this on a weekly basis, you're pretty much right on that 20-week moving average line. Is it possible that we get support like we did here and it keeps going higher? Yes, it's possible. The problem from my perspective is that as price is moving higher here in 2021, the relative strength is going down. Okay, it's diverging. Price is diverging from the relative strength, and after divergences like that, it's a bearish divergence, meaning you're expecting the market to go down. And that's exactly where we are right now. We had a peak back there in June, and it was also a peak in relative strength. And so we have this pullback, and we have this really strong price move back up to the 1618 level, right? But the relative strength wasn't as powerful a move as it was going into that first peak. So the power behind the move is decreasing, and the market rolled over. But again, if you're following it on a weekly basis, could we get support there? Yeah, it's possible. So we'll have to see. On a daily basis, you're down. C Fund was down 4.25% for the week. That's the biggest down week since I think March of 2023. S Fund. The thing about the S Fund, the problem is that the S Fund isn't anywhere close to its prior high. And it's been a long time, right? 2 years since the S Fund has peaked. So it's just very weak, and the economy cannot survive on the Magnificent Seven for very long. It's amazing that it has hung in there for as long as it has, but relative strength, you got lower highs, right? It's got support there at that 50 RSI line, but once that breaks on a weekly basis, it just keeps coming down. The next couple of months are going to be interesting, but what's going to be really interesting is the first quarter of 2025, in my opinion. Okay, iFund, we've been talking about this for a while. It hit that 82 level 3 times back in 2021. Had the big move down in 2022 with everything else, came back up, hit 82 a whole bunch of times, got back above it a couple weeks ago, and then immediately rolled right back over. I wasn't super optimistic, to be honest, that we were going to break through resistance here, because relative strength is going down as price is trying to break through this resistance level. So the power of this move is decreasing, and you have the ceiling up here at that resistance level. So if RSI had been increasing, there would have been a very good chance that we could have gotten through here and kept on going. But these technical indicators tell us the strength of the underlying price move, and it wasn't great, and it reversed. And then the F Fund, people keep saying the F Fund, it's the best looking chart of the bunch. This wasn't the high. The high was kind of back here somewhere, but this move was a 20% move down in bonds. I mean, it's a historic move down, and we got a left shoulder, a head, a right shoulder, and we're starting to move higher. That's a great long-term bottoming pattern for bonds. Does it mean it's going to go up every day or every week? No, but I would expect at a minimum we get up to 103, and very likely we're up here at 120. It just depends on what happens with the economy next year, but the F Fund is definitely a good place to be right now compared to the other funds. All right, questions?
Questions, as usual, as always. If you have any questions, you can put them in the comment section wherever you found the video. Hope you guys enjoyed the video. If you want to shoot us a question and you don't have a comment section, you can send it over to support@growmytsp.com, and they will get it over to us. Hope you guys have a great week, and I think next week we'll actually be back in person.
Yes, we will.
All right, guys. Take care. Have a good week. We are out of here.